Hi, everyone. Welcome to our live event today. Thank you so much for joining us. My name is John, and I'm your host from the Questrade education team. And joining me shortly is our very special guest. But before we get started, let's quickly go through some notes for the event, along with a disclaimer. So today's session will be recorded, and we'll have the on-demand version available early next week. If you have to duck out early or would like to rewatch an important section, we've got you covered. Please keep an eye on your email inbox for the recording. And if you have any questions throughout the presentation, please type them into the Q&A window available at the bottom of the Zoom interface. That's Q&A and not the chat window. Our agents can help answer simple questions throughout the presentation, and we'll be hosting a longer question and answer period near the end of our webinar today. And if you're having technical issues or general questions about Questrade or trading, please feel free to message one of our Questrade support agents via direct chat. And here's a disclaimer. Please remember that the information conveyed in this webinar is for informational educational purposes only and does not constitute advice or recommendations by Questrade. All right, now moving on. Some important tax dates. Starting off with some important information that we'll continue to reference later on in the presentation. Here are your upcoming tax dates to keep in mind. Firstly, we have the RRSP contribution deadline fast approaching. If you haven't already made an RRSP contribution this year, now's the time before the deadline on March 1st. Remember, by contributing to your RRSP, you can reduce your total taxable income for the year, which can help you qualify for a return. We'll go into more detail about this shortly. And coming up later down the line are the personal and self-employed tax deadlines of May 1st and June 15th. These are the dates that you need to keep in mind that you'll be filing your return with the CRA by. And lastly, if you own a corporation, your deadline for filing is 6 months after the end of the year of your tax year, which can vary by company. If you don't already have a Questrade RRSP, it's extremely easy to get started and make your first contribution within minutes using our instant deposit feature. Feel free to scan the QR code on your screen to automatically open the Quest mobile app, our app for everyday investors. You can easily set up a new account or a second account in minutes, and we're here to help if you have any questions along the way. All right, now before we move into the main event and introduce our special guest, Yannick, I'd like to quickly take everyone through where you can find your tax slips on the Questrade website. So just bear with me for one moment here. Perfect. So the first thing we'll need to do is log into your account on the Questrade website or using a mobile browser. After you've logged in, you're simply going to head over to the Reports tab up top and click on Tax Slips right here at the bottom. On the Tax Slips page, it's important that if you have more than one Questrade account, you're selecting the appropriate account up top. And let me just zoom in a little bit. You'll be able to see each individual year you have tax slips available for. For example, in this test account, I have some tax slips from last year available. We'll cover which slips are going to be available when, and if you have any questions, please feel free to ask in the Q&A, and we'll do our best to cover them throughout the presentation. All right, now without further ado, I'd like to introduce our special guest speaker today. Yannick is a seasoned tax professional with over 10 years of in-depth experience in the field. As a former owner of a tax firm in Quebec and now the learning specialist with H&R Block, Yannick brings a unique, diverse perspective to the tax world. He's experienced in serving both retail and corporate clients and has a deep understanding of Canadian, Quebec, and US tax regulations. We're very excited to have him here to present today. So without further delay, I'd like to pass things off for the main event. Thanks again, Yannick. Take it away.
Thank you, John. Thank you for having me. I'm very happy to be here today. We're right around the corner of tax season, or even I would say we're right in tax season. Now is the time more than ever to start thinking about your taxes. That's exactly what we're going to talk about today. So your RRSP contributions, your TFSA, how your income outside of those registered accounts are being taxed. And we're going to conclude the presentation with some general tax advice, general tax tips, general tax deductions that you can claim on your tax return this year for your 2022 taxes. So let's start with your registered accounts. So both accounts, so the RRSP, the TFSA account. So you'll notice that in both accounts, the income that you earn during the year is not taxable immediately. And in the case of the TFSA, though, the income that you earn in this account will never be taxable. But there are two exceptions to this. So the first exception is if you have over-contributed to your account. And the second exception is if you have received dividends from US corporations, for example. So there will be US taxes withheld at source. And the reason I mention this is that we see this as a mistake often in practice. So people, because when you pay US taxes on US dividends that you received during the year, you received a tax form, a tax slip at the end of the year that is called the 1042S. And on that tax slip, you'll see the US taxes you have paid on your US income. And it would be a mistake to claim that tax as a foreign tax credit on your tax return, because the income that you earned is in a registered account, so either in an RRSP or TFSA, for example. So this is a mistake we see often in practice. You cannot claim the dividend, the foreign tax credit on any foreign taxes you paid inside a registered account. And then when it comes to contributions, there's a big difference between RRSP and TFSA. So the contribution that you made to your RRSP is tax deductible in the year that you made that deduction. That means it will reduce your taxable income. And this has two significant consequences. So the first consequence is that you will save taxes on the amount of your contribution, depending on your marginal tax rates or that you're at. And then the second significant consequence is that you will potentially get more out of the credits that are calculated on your net income, on your taxable income. And I'm thinking specifically of the child benefits that you can receive if you have children, the medical expenses tax credit, also the GST credit that are calculated based on your net income. The RRSP room that you have never disappears until you are 71 years old. However, when you withdraw the money from your RRSP, you do not get a new contribution room, as it is the case for TFSA. So, for example, as of today, February 15, you withdraw $1 million from your TFSA because the investment you made throughout the years increased significantly. That means on January 1st, 2024, you'll be able to recontribute that $1 million to your TFSA. That's what we mean by your contribution room being reinstated, which is not the case for the RRSP, because when you withdraw money from your RRSP, this contribution room is lost forever. Of course, every situation is unique, so we have to remain careful when we give advice about RRSP, TFSAs, but as a general rule, the RRSP is often used as for more longer-term saving goals, and for example, retirement planning. And this is because the tax saving opportunity is bigger throughout time. So an example of this would be if today in 2023, your taxable income is $110,000. You contribute $5,000 to your RRSP, so you will have a tax saving of 26% for federal tax purposes. So that is the federal tax rate that you will save on your RRSP contribution. But then if in many years from now, when you're retired, for example, you have a lower taxable income, let's say of $40,000, and then you withdraw that same $5,000 that you have contributed to your RRSP, you will pay taxes at the first bracket, which is, for the federal purposes, 15%. So throughout time, you have changed an income that was taxed at 26% to an income that is now taxed at 15%. So there's a huge tax saving there on opportunity on those RRSP contributions, which is not the case for TFSA, because the withdrawals from your TFSA are not included in your taxable income. That's why often people will use their TFSA for more short-term saving goals. For example, for holidays, if they want to buy a cottage also, this is a good opportunity for it. You have here a summary of the different types of accounts that you can open with Questrade, for example. So we have the RESP, the RRSP, the TFSA, and then we have non-registered accounts. And what's very, very, very important to keep in mind for all those accounts is the maximum amount you can contribute, because there are severe penalties if you over-contribute to those registered accounts. For the RESP, there's a lifetime maximum of $50,000. For the RRSP, you accumulate every year 18% of your earned income from the previous year. And so you accumulate that amount as RRSP contribution room. And as I've said before, this contribution room never disappears until you're 71 years old. There's a maximum yearly that you accumulate as contribution room in 2023, that is $30,780. And when we say 18% of earned income, what is earned income? Earned income is usually employment income and also self-employment income net of your business expenses, so after your business expenses. So it's important here to mention that if you operate a business through a corporation, so you have incorporated your business and you only receive dividends from your corporation, you won't accumulate any RRSP contribution room, because then you only receive dividend. Dividend is considered as passive income, investment income. It's not considered earned income. And then for the TFSA, there's on January 1st, 2022, we all have accumulated a $6,000 contribution room. I say we all have accumulated, that will be every one of us that is at least 18 years old and a resident of Canada. And as of January 1st, 2023, we also have accumulated $6,500 as new contribution room to your TFSA. And as I've mentioned before, you can contribute to your TFSA the annual maximum limit. So for example, $6,500 for 2023, but also you can contribute any amount that you have withdrawn from the previous year from your TFSA account. And then finally, for non-registered accounts, there's no contribution limit, so you can contribute as much as you want. There are two places where you can find your contribution limit to your RRSP and TFSA. The first place is on your notice of assessment that you receive from CRA, either if you receive it online or by mail. That's one option. And then the other option is to go online on your CRA My Account portal. So you have access to this information there. However, we have to be very careful, because what you see when you go on your CRA My Account portal is the information as of January 1st from the last year, from the current year. So here, for example, what you see on the screen is the information that you would see if you connect today on your CRA My Account portal. You'll see the information as of January 1st, 2023. So to those limit here that you see on the screen, you would have to deduct any contribution that you have made, sorry, since January 1st, 2023. There are two situations where when you can withdraw money from your RRSP tax-free, so on a tax-free basis without paying taxes on those withdrawal. The first situation is for the home buyer's plan that allows you to withdraw up to $35,000 tax-free from your RRSP in the year that you buy your first home. And it's important to mention that there's no specific criteria to as for what the money has to be used for. So you can use that withdrawal as a down payment on your house. You can use it to change the floor of your bathroom, or you can even use it to buy a car if you want. And then the second option to withdraw money tax-free from your RRSP is a lifelong learning plan that allows you to withdraw up to $10,000 from your RRSP when you study full-time in a designated institution. Two other considerations when you contribute to a registered account. The first one is there's no upper age limit when you contribute to your TFSA, which is not the case for the RRSP. So for the RRSP, in the year that you turn 71 years old, December 31st is the last day that you can contribute to your RRSP, and which is not the case for the TFSA. And then the second consideration is that TFSA withdrawals do not affect your eligibility to government programs. And I'm including in that the Old Age Security Guaranteed Income Supplement that is calculated based on your net income. So if you withdraw money from your RRSP, that withdrawal is added to your net income, and thus you might get less from the Guaranteed Income Supplement, you might get less from your child benefit, you might get less from your GST credit if you're eligible also. However, when you withdraw from your TFSA, these programs are not affected by your withdrawal. So it's important to keep that in mind as well. What about non-registered accounts now? How are these income taxed on your returns? So there are three main types of income that you can receive from non-registered accounts: interest, dividends, and capital gains, and they are all taxed differently on your return. So it's important to understand how they are taxed to understand which one might be more beneficial for you, or which income you might be more interested in earning in your investments. So when you choose your different investments, I mean, interest. So 100% of the interest income is included in your taxable income. So you will pay taxes at your marginal tax rate, depending on the amount that you have received as interest. Dividends, when you receive dividends from Canadian corporations, it's important to mention Canadian corporations, you are eligible for a tax dividend credit that lowers the taxes payable on that income. That means for the same amount of dividend that you would receive of interest, you will pay less taxes on Canadian dividends than you would on interest. And then there's capital gains. So capital gains, there's only half of the profit that you made when you sell an investment that is included in your taxable income. That means you pay less taxes, again, on a capital gain than you would on interest income. And we have included in a later an example of this, so we're going to come back to it. But just before we move on to our example, what is a capital gain? How does it work? So a capital gain happens when you sell an investment for a higher price than you bought the same investment. And there's, as we said, there's only 50% of that gain, of that profit, that will be included in your income, and that profit will be reduced by any capital loss that you made during the year. That capital gain can also be reduced by any unused capital losses that you have from previous years. Then a capital loss is completely the opposite. So that means you buy an investment for a higher price and you then sell it for a lower price. So it will result in a capital loss. And as for capital gains, there's only 50% of that loss that is deductible against other capital gains. You can either deduct that loss in the year that you made the loss if you have any capital gains, or you can carry forward that loss indefinitely. So there's no limit in time as for when you can carry that loss. So you'll be able to deduct it against any capital gains you make in the future, or you can also choose to deduct that loss against any capital gains you've made in the 3 previous years. We have included here an example of an income of $1,000. So how would that income be taxed depending on the type of income on your tax return? So as for interest, we've said if you receive interest, there's 100% of that income that is included on your taxable income. So that's why you see here $1,000 that will be added on your tax return. If you received $1,000 of eligible dividends, so dividends from Canadian corporations, you'll be able to claim a dividend tax credit of $207 on your tax return. And then the last option is if you have made a profit of $1,000 by selling an investment or selling a share, for example, of a corporation, then only $500 of that profit will be included on your taxable income, in your taxable income. Let's move on now to general deductions you can claim on your tax return. So home office expenses, it's not new this year. This has been going on now for a few years. It was especially popular with, well, in the context of COVID that we all know. There's still 2 methods that you can use to claim this home office deduction in your 2022 tax return. So the first method is what we call the temporary flat rate method, which allows you to claim a deduction of $2 per day up to a maximum of 250 days. In 2022, but it's very, very important to keep in mind that to be able to claim any home office expenses, you need to be working from home at least 4 consecutive weeks during the year, and you have to be working from home because of COVID-19. So not because if your employer is only offering you the choice to work from home, but you also have the choice to work from the office, then you're not working from home because of COVID-19. The other method that you can use to claim your home office deduction is what we call the detailed method, for which you need a form. So you need a form T2200 signed by your employer. And this method will allow you to potentially claim more expenses than you would with the deduction of $2 per day. So the expenses you'll be able to claim is based on the real expenses you have paid for your home during the year. Childcare expenses is another deduction you can claim on your tax return, and it acts on your tax return. It acts the same way that a contribution to an RRSP would. That means it reduces your net income, reduces your taxable income, so you can potentially get more of other other credits, other deductions on your tax return. The eligible expenses that can be claimed include nursery schools, daycare centers, nannies, overnight boarding schools as well, and even day camps and day sports schools that provide childcare with the activities. It's already dictated by the income tax law which of the two spouses will be able to claim the deduction for childcare expenses. And it's usually, so it's not a choice, it's usually the taxpayer with the lower net income. But there are exceptions to this, and it's important to keep in mind those exceptions because some of them might be common exceptions. So we have included the most common here on the screen. So this includes if one of the spouse is attending a full-time or part-time educational program, or if one of the spouse is not able for caring of the children because of an impairment in a physical or mental function. So if that taxpayer has a lower income, and is either has an impairment or goes to school full-time or part-time, that means the spouse with a higher income will be able to claim the childcare expenses. And this makes sometimes a very big difference on your tax return because the childcare expenses act as a deduction. So that means the tax savings you make are based on your marginal tax rate. So a taxpayer with a higher net income will have a higher tax saving of those childcare expenses than would a lower net income taxpayer would. Home buyer deductions and credits. So the home buyer's amount, it's not a new credit. This credit has been going on for years now, but this year in 2022, it has been doubled. So it went from $5,000 to $10,000. So that will make a big difference for people that from taxpayers across Canada that bought a house in 2022. There's also the GST HST new housing rebate that you can receive if you purchase a new house, or if you substantially renovated. Substantially renovated means at least 90% of the house has been renovated. So that's a huge percentage. Of the interior, we say here on the screen, a substantial renovation means at least 90% of the interior of the existing house must be removed or renovated. And then there's also the GST HST new residential rental property rebate, and that can which is similar to the new housing rebate if you are building and renovating a multi-unit residential complex. So those two last rebates, so the GST new housing rebate and the GST new residential rental property rebate, these are credits that you claim outside of your tax return. So it's a different process. You don't include those rebates on your tax return. As for the home buyer's amount, this is a credit that you can claim on your tax return that you're going to file in the next weeks if you have bought a house in 2022. Spousal RRSPs. So when you contribute to your spouse RRSP, there are three things that you need to keep in mind. And this is often, these are often mistakes that we see in practice. So the first one is when you say that you contribute to your spouse RRSP, that means the money went from your bank account directly to the RRSP of your spouse. So you did not give money to your spouse so she or he can contribute to her RRSP. That wouldn't qualify as a spousal RRSP contribution. So it's very important that the money goes directly from your personal account directly to his or her RRSP account. So this is one mistake that we see a lot. Then the second mistake that we see a lot is when you contribute to your spouse RRSP, it will affect your own contribution room. So it's always the person contributing to the RRSP that will be affected, that we will look at his or her contribution room to know if they can contribute, if they have enough room to contribute to the RRSP. So even though you are contributing to your spouse RRSP, it's your own contribution room being affected. And then the third mistake that we see a lot is about withdrawals. So withdrawals, when you contribute to your spouse RRSP, the main objective is that when those contributions will be withdrawn from the RRSP, your spouse will have a lower taxable income than you would have. So then you will benefit from this tax saving, because the withdrawal will be taxed at a lower rate than they would have been taxed if you would have made those withdrawals. But if you withdraw the money that you contribute from your spouse to your spouse RRSP within 2 years of this contribution, then it's not your spouse that will be taxed on the contributions. You will be taxed on those contributions. So it's important to keep that in mind. There's a delay before you can withdraw the contribution you made to your spouse in order for your spouse to be taxed on those withdrawals. We have included here an example of a tax saving opportunity when you contribute to your spouse RRSP. So it's the example here of Jane and Joe, who are residents of Alberta in their 40s. Jane, sorry, let me just move this so I can see the whole screen. Perfect. So we say Jane has a taxable income of $150,000, has a high RRSP contribution limit. And if she made a $5,000 contribution to Joe's RRSP in 2022, she will be able to claim this contribution against her income and will get tax savings of about $1,900. Many years later, when Joe withdraws the money, he has a taxable income of $45,000 before the RRSP withdrawal. Assuming there's no changes to the tax rates during those years, he will pay taxes of $1,250 on the withdrawal, since it's counted against his income. And since Joe and Jane are pooling finances in retirement funds, they have saved $650 in taxes using this strategy. And here, the example is only with $5,000, but imagine this example going on for many years. For all their retirement, this will make a big difference in the money available to them in after tax for their retirement. Preparing for tax season. So as I said when we've just started the presentation, it's already time to start preparing for your taxes. John mentioned it at the beginning. So the limit date to contribute to your RRSP for your 2022 tax return is March 1st. So this is in only 2 weeks. So now is the time more than ever to start gathering all your paper, all your documents, make sure you have everything ready for your taxes. And think especially of all those credits and deductions you can claim on your return that for which you don't receive slips. So this is often what people forget when they prepare their documentation for their taxes. So all those credits that no one is sending you a slip in the mail. So I'm thinking of medical expenses. So during the year, if you went to the dentist, if you bought glasses, if you went to physiotherapy, psychologists, those are all professionals that qualify for the medical expenses credit. Of course, you have to consider also any reimbursement that you received from your group insurance or your private health insurance also. So you might need to get a report from that group or private health insurance that mentions any reimbursement that you received during the year. Think also of any donations that you've made. Sometimes we receive those tax received in our emails. So think of those. Also, if you paid any interest on a student loans, those are eligible for tax credit as well. If you've paid professional dues, union dues also outside of your pay, that were not taken directly from your pay, then you can get those receipts ready as well. If you've paid those contributions directly on your pay, this amount should be included on your T4 slip. So in box 44, if you look at your T4 slip from your employer, you'll be able to see that professional contribution there. So we've mentioned it before, the deadline to file your personal tax returns is May 1st, 2023. This is also the deadline to pay any taxes that you owe. And this is a mistake that we see a lot in practice, is people think that because you don't owe any taxes, for example, if they have contributed to an RRSP or they know they've made too much tax installments, so they expect a refund from CRA, they file their taxes late, and this is a very, very big mistake. It is true that the late filing penalty is calculated on the taxes that you owe at the end of the year. However, so that means that if you don't owe any taxes, you won't have any late filing penalty on your tax return. That is true. But there's a big but here, because when you file your tax return, sometimes there are tax elections that are available to you, and you don't have to be in a very complex situation to qualify for those elections. I'm thinking, for example, of someone that met a new spouse during the year, moved with a spouse, and then started to rent their previous home or previous apartment. So when this happened from a tax perspective, we call this a change of use, because the house that you were using to live, so as your personal residence, is now you're now using that house or that property to earn income. And when this happened from a tax perspective, there are elections that are available to you that can make a big difference in the future when you will sell that property. And if you file your taxes late, where I'm going with this is that if you file your taxes late, even though you don't owe any taxes, that the tax elections that you make on your tax return will be late, and then you can have penalty for those late tax elections. And not only that, there might even be some tax elections that are not available to you if you file your taxes late. So for all these reasons, it is very, very, very important that we file our tax returns on time. You'll make sure that you get everything you're entitled to on your tax return. So and then with H&R Block, there are different ways that you can file your taxes. You don't even have to come in an office. You can upload your documents directly from home, and you'll be able to, and your tax return will get prepared by an expert, like a real person. It's not a robot. You'll be talking to a real person that will help you file your tax return. You can also do it yourself. So you can use our own software. It's very friendly user. It's available online. You can file your taxes either for free or for a small fee, depending on your situation. And all the way through this process, when you file your taxes yourself, you can always get an appointment, a phone appointment with an expert if you have questions on your tax return, and you can even get your tax return reviewed by an expert once you're done preparing your return. So there are many options that are available to you to file your taxes. So that's pretty much it, all the content I wanted to cover with you today. I see there's a lot of questions in the Q&A, so we'll get time to answer those questions.
Perfect. Thank you so much, Yannick. I really, really appreciate the presentation, and I know our customers probably learned a lot too. Just bear with me one moment. I'm going to take over screen share, and then we're going to slowly get into the Q&A here. In fact, I realize actually we probably don't need the screen share for the questions and answers here. All right, everyone. Thank you again. I see we've got 30 questions, so we're going to do our best to get through all of them, but just given time constraints, we'll probably pick around 5-10 questions to get through to respect everyone's time today. As Yannick mentioned, if you do have additional questions, feel free to take advantage of the H&R Block offer and the generous services that they offer throughout their website and the file with an expert. All right, so we'll start with a couple of simple questions here and get into some more complicated ones down the line. And here's a simple one for childcare related. Are we able to claim tutoring costs? So if I have a child, they need some math tutoring, maybe some science. Am I able to claim that in any way, shape, or form?
That's a very good question. You'll be able to claim that expense often not as a childcare expenses, but as a medical expense, depending if the person offering tutoring is a qualified professional. Yeah.
Oh, nice. Okay, so it's very important that they have some sort of credentials and stuff like that in case.
Absolutely. Yeah.
Perfect. Thank you so much. And we've got another question here about some capital losses. So this would be in a margin account. Do I have to report it in the year that it incurred, or can I report capital loss? Like, let's say I had one back in 2021. Is it too late?
That is very important to mention. I'm glad we have this question. As for taxes, when an event happened during the year, would it be a capital loss or you contribute to your RRSP? And when you have different options available to you, 99% of the time, you will need to include that event on your tax return in the year that the event occurred. So it is true for a capital loss. So if you sell an investment for a lower price than you bought that investment previously, you'll need to include that loss on your tax return during the year that the loss incurred. However, that doesn't mean that you need to claim the loss in that year. So if you don't have capital gains in that year, or if you prefer to keep the loss for a different year, you'll be able to do so, but you still need to include the loss in the year that it was incurred.
That's a really great distinction there. So make sure to report it, but you don't necessarily have to claim it.
Exactly. And that makes me think also to mention RRSP contributions, because this is a mistake we see often in practice. Sometimes people contribute to their RRSP and they prefer to keep the deduction for another year. Well, you cannot just appear with your RRSP contributions in a few years. In the year that you contribute to your RRSP, that is the year you need to include the contribution on your tax return. And then on your tax return, you can choose to keep the deduction for another year. So there's no limit in time to when you can deduct that RRSP contribution, but you still need to include it on your tax return in the year it was made. And that also counts for the contributions that you've made in the first 60 days of the year. So for example, today, February 15, if you contribute to your RRSP, this contribution counts for your 2022 tax return. If you choose to keep that deduction for your 2023 tax year, you still need to include that contribution on your 2022 tax return. Because then you'll get on your 2023 tax return, and then the first line on the RRSP schedule says, what is the amount from the previous year that you haven't deducted? So that's where you enter that amount that you want to deduct, for example, in 2023.
It's a really great point, Yannick. I personally was confused a lot by this when I first started contributing to an RRSP. So it's really important for the audience to take that in mind. Make sure to report it, but you don't necessarily have to claim it. If you want to carry it forward, maybe to a year where you've got a lot higher income coming in or something like that, may make sense to chat with a tax planner or something like that.
Absolutely. And we often see the mistake happening with people that contribute automatically to their RRSP on their pay. So they don't necessarily think that they have contributed in the first 60 days, for example. And so they want to keep that deduction for another year, but you still need to include that amount on your previous tax year.
It's a really great point. And just a quick tip for the audience as well, those with a Questrade RRSP, when you make a contribution, our tax slips are generated within 3 weeks. In my own experience, I'm getting them within a couple of business days, but at the latest, we will issue your RRSP contribution slips within 3 weeks. So even if you wait until the very last day to make a contribution, you should be getting your slip by mid-March. All right, we'll do a handful of questions here. I see there's a lot of questions and I'm trying to get my agents to get through as many as we can. Unfortunately, we're not going to be able to answer any very specific individual tax-related questions since that borders advice, but we are able to answer more general questions about investing and taxes and things like that. So we've got another deduction and expense-related question here related to subscriptions to stock tracking, live quotes, maybe online publications, screeners, that sort of thing. Let's say someone does a lot of trading and they're subscribed to a bunch of different web services that help with their trading, some kind of analytics tools, quotes. Am I able to deduct any of that in any way, shape, or form?
It's an interesting question. The answer would be yes, but as as many questions related to taxes, there's always a but. So that means it all depends in what form you're investing. So if your investments are more long-run investments, you don't really put much time in your investments. This is for your retirement, for example. This is for then you're not operating a business, right? It's only investment that you have for the long run. And then the opposite situation would be where you are definitely operating an investment business. That means on a daily basis or on a very frequent basis, you spend a lot of time researching your investments, selling investments, researching potential investments. So if your activity is considered as a business, then you'll be able to deduct all related business expenses, and those would include any subscriptions you made to newspaper or software online to manage your investment as well. Yeah. But then if you only have an investment account that is not considered a business activity, you won't be able to deduct those expenses yet.
Perfect. I really appreciate the thorough answer because as with taxes, like you mentioned, it's always it depends. So appreciate all the little tidbits there. On that topic, can management fees for my brokers or maybe a TFSA or an RRSP, if it's a mutual fund or an ETF, can I deduct that management fee somehow?
I laugh because those are all good questions, in that these are questions we see a lot in practice. So the management fees that you pay in your investment account, again, sometimes it's deductible, sometimes it's not. So we have to be very careful. If you paid investment fees or any other fees inside your registered account, so RRSP, RESP, TFSA, those fees are not tax deductible. However, if you've paid management fees for your investment in a non-registered account, those management fees will be tax deductible. But again, management fees does not include all kind of fees that are charged in your account. Sometimes you pay, for example, a commission on if you sell a share. So that commission is not considered a management fee. So that commission will be either added to the cost of the share that you bought, or will be added to the product of disposition. So the price of the sale of the share that you sold. So it will be deducted in some way. It just won't be deducted as management fees. But the regular management fees that you can deduct if you have a non-registered account, often you receive at the end of the year, you would receive a report from your financial institution that mentions those management fees, and then you'll be able to deduct those on your tax return. For Quebec purposes, there's an exception. So those management fees are deductible up to your investment income during the year. Mm-hmm. But in other provinces, you can deduct the whole amount no matter what is your investment income. Yeah.
That's great, Yannick. Thank you so much. So main thing to kind of keep in mind is margin accounts, non-registered, it's usually a yes, whereas with registered RRSP, TFSA, it's usually a no.
It's always a no if it's always in a registered account.
Got it. Perfect. All right. We've got a couple of questions here about Canadian ETFs and maybe the dividend tax credit here. So let's say if I invest in a Canadian ETF, so it's issued by maybe a Canadian bank or a Canadian issuer, but it tracks the US market specifically. So maybe it's like an S&P ETF or it's a covered call ETF. How am I taxed? Because the ETF is a Canadian issuer, but the products inside the ETF are American. Do I still qualify for the Canadian tax credit because it's a Canadian company that the dividend is coming from?
No. So the payer of the dividend would be, for example, here, an American corporation. So when the American corporation pays the dividend, that's when these dividends wouldn't qualify as Canadian dividends. Mm-hmm. So those funds do not only distribute dividends. That's why when you receive, for example, your T5 slip or your T3 slip from those financial institutions, there are many boxes. There are amounts in different boxes, and it's because you can receive different types. It could be eligible dividends, could be non-eligible dividends, could be also capital gain dividends that are taxed differently, also that are taxed like capital gain. So it's very important that you look at your tax slip, and then you make sure also you have all your tax slip when you file your return, because this is the information you will need and to file your tax returns. Yeah.
Definitely. I know I ran into this myself, buying some covered call ETFs, made some assumptions, and the dividend isn't always a dividend, if you know what I mean. Sometimes they're distributions from the fund, and those are taxed differently, like you mentioned. Mm-hmm. So generally, the more complicated the ETF, the more complicated, unfortunately, the tax situation with it too. Okay, we've got, I think, a little bit more time for one or two more questions here. I'm going to scroll through. I see we've got 55, and I apologize to the audience. We don't have time to get through every single one today. As we mentioned earlier, if you've got a very unique, specific tax question, feel free to contact our friends over at H&R Block for some help with filing. They've got some great fee-only services, file with an expert online. Let's see. And any questions related to Questrade specifically when you're going to get your tax slips, feel free to consult our learning resources online that some of my colleagues have linked in the chat, and I'll link back to that at the very end of the presentation as well. All right, we've got a little bit more of a complicated one, but how would you report capital gains losses on a short trade? So instead of buying a security and holding it and then selling it, I'm doing the opposite. I'm shorting something. Is it basically just the exact opposite?
Yeah, absolutely. Because for tax purposes, we look at what you've paid and what did you get what did you get from that transaction. So it would be the same process, yeah, for tax purposes. Yeah.
Perfect. Yeah, the main difference being when you're buying something and going long, you pay the money up front and then you get your money back, hopefully again, when you sell it later. Whereas with the short, you're going to get the money up front and then later you pay back and hopefully you've made the difference there in the short. A little bit more complicated, but it's just the opposite, if that makes sense.
Absolutely.
And maybe we'll touch on one last question for options here specifically. I see there's a lot of options questions. We only have time for one, unfortunately. So if I have an option that expires worthless, I don't end up selling it before, am I able to claim that as a capital loss?
So that would be an option that you have exercised so that you bought the share already?
So you haven't exercised the contract. So you bought an option contract, you're hoping it's going to be profitable, and unfortunately, maybe it's out of the money. So you don't end up doing anything and it just expires worthless. Can I claim that as like a total loss, basically?
Well, that would be a capital loss, so not a total loss, because you've paid something for a property that ended up. It is as if you sold it for $0, right? So it's important to mention that you can only claim that loss when the option is expired. So not whenever you decide that you won't exercise the option.
Yeah.
You have to wait until the option is no longer exercisable. So you won't be, so when you're definitely sure that you won't get any money out of it, then you'll be able to claim the loss on your tax return. Yeah.
Perfect. Thank you so much, Yannick. I really appreciate your time today. We are just about at time. So right before we wrap up, I'm going to help answer a couple of Questrade related questions as well that have come up on how to contact us, how to open an account. As mentioned earlier, if you are interested in opening an RRSP account, making that contribution before the deadline, feel free to scan the QR code on your screen now to be taken automatically to either the Google Play Store or the iOS Store to download the Quest mobile app. You can set up an account in a couple of minutes if you'd like and make your contribution. And if you're interested in getting a hold of us, chatting with us, if you have more questions after the event, feel free to use the big green chat with us button available at the bottom of the Questrade website. For any other additional questions, we'll do our best to go through them after the event. And for the recording, that should be available mid next week as well. Thank you again, Yannick. We really, really appreciate your time today. And any final comments for the audience?
File your taxes on time. We've mentioned it, but also not file your taxes on time. But now is definitely the time, as we've mentioned, to look at your contribution, your RSP contribution room. There's still 2 weeks left. You can even start filing your taxes without sending them to CRA yet, but you can prepare your tax return, see what's the result, see if it will be beneficial to contribute to an RRSP. You can do so for the next 2 weeks. So to see what would be the difference if you contribute to an RRSP, what else? Yeah.
It's a really great point. Start early, even if you don't have those T4s yet from your employers, like a lot of us, or haven't made that final contribution room. You can start kind of plugging those numbers in, start calculating and planning ahead. That way you're not maybe scrambling right before March 1st to make that contribution.
Absolutely. Yeah.
Awesome. Thank you so much, Yannick. Thank you, H&R Block. And thank you to everyone in the audience for your time today, and have a great rest of your day today.
Yes, thank you. Thanks for having us.
Thanks, everyone. Bye-bye.